Welcome back. The president was overseas and Congress was on recess. So it comes as no surprise that little was done to move the ball forward on both health care and tax reform this past week. Two massive promises from the Trump administration that investors are counting on. With half of the year already in the books, is it time for investors to consider that this doesn't get done? Mark Mobius is back with us, and you said health care will be hard, but you are expecting some kind of tax reform, even if it's just tax cuts.
Exactly. I think that's in the cards. I think most people want that, and they believe that will boost the economy to a great extent.
Now, we should point out that Mitch McConnell is trying to get something done on health care as well. They want to save money by doing health care first. I question that they should have done tax reform first, but
that's what I think.
That's another conversation.
Tax reform will be much easier if they do the tax reform.
Yeah, but you think that the tax reform package will be lower corporate taxes, lower individual taxes, and that just spurs behavior. People will spend more money and invest more.
Exactly. And I think in the long run, it'll bring more money into the economy and into tax collection at the end of the day.
Which is exactly. People look at tax receipts to get a gauge on the economic growth story. All right, tell us how you invest in the U.S. You invest in companies that have a significant exposure to emerging markets.
An increasing number of companies in the U.S., in Europe, have exposure to emerging markets, and many of them could even be considered emerging market companies because over 50% of their earnings are in emerging markets. Unilever would be one example, and you're seeing increasingly this is the case.
So is that what you want to do? I mean, for viewers at home, should they be identifying those companies that have a significant amount of their earnings in these growth hotspots?
Absolutely. This is something they should look at. Look at a company and see where they are. What percent of their earnings are in emerging markets, in China, in India, in these high-growth places.
Tell me what looks good to you in terms of individual names or ETFs, in terms of what fits that bill.
Generally speaking, we're looking at companies in the Internet space, and I don't mean just companies like Google or Yahoo, companies like that, but companies that have a big part of their earnings in emerging markets. And, of course, the Chinese Internet names would be probably at the top of the list. And also those companies that have technology such as robotics and integrated circuit technology that is being done in emerging markets. I think these are high growth, very interesting areas. So you first get the category high growth and the country high growth. That combination can't be beat.
This is a really interesting point that you make, because robotics is an area that we talk about a lot in the U.S., but it's probably just beginning to get traction in some of the emerging markets, isn't it?
Actually, now
it's even ahead of the U.S.?
Ahead of the U.S. in many areas. China recently purchased one of the largest robotic companies in Germany for the technology. I was visiting the BMW plant in China, and it was all robotics. The cars were being made automatically by the robots. Very few people actually on the line.
That is incredible. So what does this tell us about where things are going in terms of the Internet-related growth stories?
Well, the combination of Internet plus robotics is an incredible, powerful medium. And you're going to see more and more of this combination taking place.
So in terms of the risk of a market meltdown or anything substantial on the downside, what's your take?
There's no question. You know, we have a situation now where we have to wind down this incredible liquidity that's in the system. And there will be bumps along the way. And there's a possibility of a market crash taking place sometime in the future. But look, at the end of the day, there's so much happening around the world. We cannot focus on that. We've got to look at companies that have good corporate governance, that are growing well, and regardless of what happens, these companies will survive.
So those worries haven't stopped you from putting new money to work in this market?
Absolutely. I think it'd be a big mistake for people to say, look, I'm afraid there may be a crisis, therefore I'm not going to invest. It doesn't make sense, because at the end of the day, those who invest in good companies will do very well.
You think the emerging markets recovery will only get stronger? It's here to stay? Because there have been some false starts.
Yes. I think this recovery will last at least 5 years. Usually that's a cycle that we see in these, and we started last year with emerging markets, so we have quite a few years to go.
And growth in the U.S. is beginning to pick up as well.
If growth in the U.S. reaches 3%, that's great for the whole world, because everybody benefits. So you're going to see a very, very positive situation on a global scale.
So what areas would you be looking at in that regard in the U.S. if we were to see that kind of growth, 3%?
I would still look at global companies, globally oriented companies with good brands. You must remember that in many of these countries, particularly in the poorer emerging markets, brands are important. Because when people go to buy something, they want to make sure that the small amount of money they have to spend is in a product that will work.
Yeah.
So you'll find that global brands are going to be very important.
It's a great point to make. Mark, it's been a pleasure to have you today.
Thank you.
Thank you so much for joining us. Mark Mobius from Franklin Templeton joining us there.